Good afternoon and welcome to the Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. Kelvin Wong, market strategist at CMC Marekts, is our guest today. Kelvin, thanks for coming in.
My pleasure again, Brian.
Now, Kelvin, before we get your insights, let's take a look at how markets around the region are performing. But before looking at markets, let's start with the crypto markets. Now, Bitcoin is at 41,374. It's up 3.13%. Ethereum is at 3,121.21. It's up 2.01%. Now, across regional stock markets, we start with the SGX. It's at 3,346.32. It's up 0.12%. Over across the causeway, in the KLSE is at 1,601.12. It's up 0.25%. Shanghai is at 3,213.7. It's up 0.83%. The ASX All Ordinaries is at 7,824.6. It's up 0.68%. The Nikkei is at 27,156.5. It's up 1.17%. The Hang Seng is at 21,465. It's up 0.43%. Rounding up the numbers, we've got the Kospi, which is at 2,718. It's up 0.04%. Now, Kelvin, what's your take on markets today? We've got a sea of green for a change.
Yes. So definitely. So I would say that it's a bit of a silver lining, at least in the short term, primarily driven by the strong performance since overnight in the US stock market, where almost all the benchmark US stock indices actually ended in the green, with, I would say, solid gains, especially on the tech heavy Nasdaq 100. So that actually create a bit of a positive feedback look into the ASEAN stock market. After at the start of the week, the US has been on a more weaker footing. So the next question we've got to ask ourselves is what's actually driving yesterday's positive performance in the US stock market, and also can this performance be sustainable in the longer term? So I'd like to share with you over here is that, in fact, one of the reasons why the Nasdaq 100 actually outperformed against the rest of the benchmark yesterday was actually a calm down in the US 10-year Treasury yield. So previously, we did share in our show over here is that the level to watch out for the US Treasury yield was this 2.55%. Yes, it did a bullish breakout last week. It actually went to a high of 2.83%. So what we could see right now, this is a long-term chart. So if you look at the bigger picture, right, the bigger picture over here is that it's actually indicating to us that in the coming quarters ahead, so we're talking about 3 months to 6 months down the road, higher cost of interest will be there. I mean, the businesses will start to feel a higher cost of funding because the US Treasury rate is considered as a global benchmark risk-free rate to actually price corporate loans and in terms of our housing loans as well. So now the next key thing is that when we talk about the markets, right, there's actually short-term perspective of the market. So let's go down to the lower time frame chart of the US Treasury yield. But take a look at this, the 10-year it's the daily chart. So you look at the daily chart, right, there's actually a resistance level. I would say it's a medium-term resistance level at 2.81%, which is actually this congestion zone over here in October 2018. So the price action actually at the start on the 12th of April, it actually reacted from this 2.18% and now showing signs of consolidation between the 2.81% and 2.55% that was taken out yesterday. So if this consolidation continues to hold, I mean, we're talking about in this big sideways range, not going above 2.81% in the next week or so, we may start to see a bit of relief rally, at least in the short term, for equities, which actually translate to potential further movement, positive movement on the US stock market. So that could actually give us a bit of relief in the backdrop of, because right now, in terms of a weaker economic backdrop that is actually that's in the minds of market participants right now, given the ongoing geopolitical risk, obviously heightened risk from this Russian and Ukraine crisis that is showing no end in sight, at least in the near term. Then another thing on the highlight over here is much more interesting is the mentality of market participants towards the Fed, because as you know, the Fed is a very important central bank that actually dictate we call it the global liquidity condition. So we know that the Fed has started to turn pretty much hawkish since the start of this year. But most importantly is the current hawkishness of the Fed. That means we're talking about Fed speak for various officials and their action can they tone down future inflationary expectation? Because markets are always forward looking. So if they could tone down this future inflationary expectation, that means, i.e., the Fed may have done one quarter of the job. That means going
Yes.
forward, they will not be so hawkish as possible, as they intended. So that could actually offer a relief in the market. So this chart what I'm sharing with you all is the green, the blue line and the orange line is actually the US 5-year break-even inflation and US 10-year break-even inflation. This level are implied for the US Treasury market. Just to keep it short, for simple term, that means what it means that 5-year break-even inflation is telling us that from today, what is the what's the 5-year inflation like? To mean future inflation 5 years from now, 10-year will be 10 years from now. So what's interesting over here is that if you look at its recent high on the mid-March. Yeah, so let me switch on to the daily charts, easier to see. Okay, so this line here on 25th of March, since 24th of March, high at around 3 point, for both the 10-year and the 5-year, all they have started to inch down pretty, slightly. That means what it means that at this point in time, inflation expectation has started to actually come down rather than moving upwards. That means what we see over here is that the reason hawkish guidance as offered by the Fed officials has started to actually fit into the market, and market participants are now trying to actually tone down their inflation expectation. That could actually also be offer a bit of sign of relief for global equity as well. And also on top of that, don't forget, oil prices has already been start to consolidate since the peak of close to about 125 per barrel during the highest point that was actually printed in this ongoing Russia-Ukraine conflict. So all in all, right, as long as we start to see a tone down in US Treasury yield, on the consolidation, a tone down in future inflationary expectations. So that could actually offer a bit of a relief for global equities, at least in the short term to medium term.
Now, looking ahead this week, we've got the upcoming China PBOC monetary policy decision
Yes.
this Friday. What are you watching out for?
Okay, so what we are looking at is this Friday, the PBOC will announce its 1-year medium-term lending facility rate. Okay, so what's this rate important over here is considered as their benchmark interest rate. So it only started it cut this benchmark interest rate since the start of this year in January by 10 basis points to 2.85%. Then thereafter, it just remains stamped for the last 2 months. That means we're talking about in February and March. So what's interesting now over here is that given the current lockdown of Shanghai, together with the previous lockdown in Shenzhen, so these are two very we call it significant commerce hub in China. So given this we call it recent lockdown, especially the one in Shanghai, which is still being locked down as per se, it's going to actually impact China's growth. So do not forget over here is that in the last couple of weeks, China policymakers, including their including their premier Li Keqiang, has started to warn that China may start to face the increased risk of economic slowdown. So that actually translates to, i.e., policymakers like the China Central Bank will actually start to actually front load or bring forward their intended expansionary monetary policy. So, but it's more targeted rather than opening the liquidity tap like nobody business.
And Kelvin, at the end of the day, that's also something that the rest of the world is hoping for, because if China opens its tap, that's kind of going to counterbalance the tightening in other parts of the world.
Yes, precisely. But do not forget over here is that I do not see that China to be so aggressive in adopting a very expansionary policy. That means I don't tend to see them cutting down rates to below 1%. If you look at the based on the 1-year medium-term lending facility rate, which is now at 2.85%. So what they want to do over here is more of a targeted approach to actually cushion any negative economic impact in the China economy. So it's more like a stabilization approach rather than a fast and furious upward expansionary approach from here. So with that in mind over here is that I do not, that means that liquidity provided by China will not be able to replace the global liquidity that's being sucked out from the Fed and the rest of the developed central banks like ECB, BOE, Bank of Canada. So I don't see at this point in time they're able to actually create a start of a very strong upside momentum into risk asset and kickstart a very we call it long-term circular bullish trend in such assets.
Now, Kelvin, thank you very much for taking your time to be on the show.
My pleasure, Brian.
Now, we were speaking to Kelvin Wong, market strategist at CMC Marekts, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank Malaysia. I'm Brian Fernandez. This video and podcast will be on our website, www.biztech.asia, as well as Rajhi Bank's social media platforms. Please like and subscribe to our various platforms. Thanks again for tuning in.